Felix here. It's not often that you hear me scream manipulation because I always think that's an excuse for people who are just putting on bad trades. But this one here smells like it. Let me show you why. SoFi downgraded today and it is down some 5%, 6% even as I'm recording this. What happened? We got Oppenheimer out saying we just downgraded SoFi stock. Now, what's the reason for the downgrade? Well, listen to this. This downgrade is purely on valuation after we suspect there's a significant short squeeze on a likely bear thesis based on account changes away from fair value accounting and inflated assumptions by management, capital capacity and worries about credit quality, which to me fundamentally seems like something that they just made up. And that's essentially what's being reported all over the place. It's on Yahoo, it's everywhere. And have a look at the short interest. So 42% of all volume is short volume. Insane levels. It was 51% at the beginning of the month. So yes, the short sellers are definitely hurting. Now, who are the lovely short sellers, you wonder? Well, the biggest one is probably Susquehanna, one of the biggest hedge funds in the US. You've got Blackstone in there and a couple of others. Now, huge amounts of puts as well, although those could be hedging. That isn't necessarily. Citadel, though, that's probably short position. So what is the problem with that? Well, the more the stock goes up, and it has been going up to the moon like mad because the student loan moratorium's over and suddenly SoFi has its original business back. Literally, they completely lost that business. And I've done some videos through that. I'm not going to walk you through the numbers again, but in my view, it's very, very significant. So what are they doing? Well, they are pausing, they're slowing down the rally, and they're reversing it down 5.7% so that their buddies at the hedge funds at Susquehanna and so on can make money. And that isn't really right, is it? But it's the way it works. And analysts are like sheeple, I always say. They tend to follow the market. They don't make the market, don't pay that much attention to them. I read analyst reports. Here's one out today, for example, with a buy rating, which nobody covered, by the way, from BTIG, saying it's a flywheel that actually turns, our top pick in the consumer fintech space, initiating a buy with a $14 price target. It's a really interesting read. I'll put this into the community if you want to join that, felixfriends.org/Patreon. And their base case assumption is $14. Their upside scenario is $21. Okay, downside scenario, $3. Essentially saying student loan moratorium returns and a large quantity of forgiveness is granted, which seems a fairly unlikely outcome at the moment. Obviously possible, but fairly unlikely. So read this and come to your own conclusion. Don't just follow a number someone's plucked out of the sky. And Oppenheimer didn't even downgrade the number, they just took away their target. And it makes me wonder whether one of their pals at Susquehanna or one of the other funds that they do business with gave him a ring and said, hey guys, let's put an end to this. This is hurting us a heck of a lot. That's my speculation, of course. No real proof of that other than very, very significant short interest here. And you can see how much they're hurting because each of these green candles here is when they fail to deliver shares. So they are shorting naked. They're not able to borrow it. And therefore, they are losing money. I mean, serious money. 2 million shares here earlier in the year in March. And there's that chart on bigger. And you can see at the end of May, 31st of May, it was 164,000 shares. So it's pretty significant stuff. So what would I do with it? Am I going to buy SoFi at this level? Honestly, I don't, because the rally is tremendous. And generally when something goes up, there is a pullback. The market doesn't work in a linear fashion. So what I do instead is I look at the options and let's walk through how we might do that. If you want to learn some more about that, there is a link down below to a free trading training I'm holding next Wednesday, the 31st, 11 a.m. Eastern time. Sign up for that. There's still about 600 spots available out of the 1,000 we made available yesterday. So they are going to go. They always do. Don't miss out on it. felixfriends.org/webinar. It's free. And I show you the strategy, the theory, and also we'll do some trades together live. So check it out. Now, in optionswatch.io, I type in SoFi stock and then I get SoFi here. And I always go out to the third Friday of the next month. That's where the institutions trade. And then I would have a look at something like an iron condor. Now, an iron condor essentially means you're thinking the stock is going to trade in a range. You're not saying it's going to go up or it's going to go down because nobody ever knows, so it's 50-50. But say we set up something like this, and this is not a trade recommendation, this is not financial advice, this is just an illustration of the sort of trade that one might be able to do, but obviously you need to understand it properly. So this trade, for example, has a 72% probability of making money, better than the 50-50, right? And anywhere between $6.84, so that's like a massive, massive collapse of the stock, to $12.16, which would be a pretty tremendous rally, 30% up. In that zone, we make money. So between this gray line here and the one up there, we make money. And how much money would we make? We could make 19%. It's an hypothetical example. Don't chuck your money at this unless you really understand options, in which case you have to make your own decision. But to me, this is a better setup than let's buy it or let's short it, which is a terrible idea because you could lose potentially like a lot of money. It's a really, really bad idea to short. So that's the kind of thing that I would look at. And if you understand the market and you understand options premiums and volatility, which is super high for SoFi, you understand that selling options is typically much, much better than buying options. So don't usually buy options. It's a bad idea all around. That is actually advice from me. So on that note, I think fundamentally nothing has changed here. There is no new news. There's no new data. Oppenheimer didn't come out with any research that we didn't previously see. They just woke up one morning and went, we're going to pretend we no longer like the stock. And a lot of Wall Street doesn't like SoFi. Why? Because SoFi is a disruptor of banks. It is a bank that steals clients from old banks because they pay higher interest and have better products and they have better cross-selling, it's a better service and all that kind of thing. And people want a bank with a responsive bank that gives them good services and good interest rates and not some of these old dinosaur banks. So you're asking the dinosaurs to give you a buy rating when you are the competitor and you are the disruptor. Well, it's probably not going to turn out that well, is it, from that front? So do your own research, that's all I'd say, and smash the subscribe button if you haven't already, and I'll keep you up to date with SoFi and everything else that matters out there. Thanks for watching.